50 CCI is downtrending towards the zero line.
Right.
But you've got triggers on the 500 and 1,000. That's
Right.
okay to take?
That's okay. That's what I call the tentative shorts. The tentative shorts where you'd be using shorter term targets. Don was asking, what happens if, and this is something we have every day. And by the way, I don't want to give the impression that these things are only good for intraday trades. We're going to be looking at some intraday trading on Monday and Tuesday because we really can't get that much done over the period of 2 days looking at live charts on daily stuff. We'll look at them, but if we want to see a lot of examples of these trades setting up, we're going to have to look at intraday charts. We use the exact same triggers though on the longer term charts, exact same stuff. Don was saying, what happens if you have a break here below the plus 100 line and the 50 is aiming towards zero? Can you take these short triggers earlier? Yeah, you can, but that's what we call our tentative short zone. In other words, this is said, the break of the plus 100 line, break of the plus 100 line is said that the upside momentum is in question, it's in jeopardy. You start getting short-term short triggers, and you can take those short triggers as long as they're on at least two of the other two time frames. As long as they're, you don't want to take just like a 500 volume short. But you have to be very careful that it might bounce back in your face. You're going to use short-term targets only, targets that would be fine for you. Okay, where are we now? How about a little break, because otherwise we're not going to have a chance to take a break until phase. Okay, the triggers we went over are the 4 CCI triggers. Now, I'm doing my best to keep this stuff, also on a day-to-day basis, as simple as possible. Yes, there are nuances, like we were just talking about, Don, about when you can take those shorter term trades, because now we're going to go over a lot of those nuances when the charts are moving, when we actually have live charts, because if we were to go over all of the CCI permutations in multiple time frames right now, the day wouldn't end until Monday or Tuesday. So what I want to really give you is a foundation to work with so that you can understand what it is that we're looking for to consider a trigger. And really, those are the 4 patterns. I can't tell you, like in our intraday stuff in the chat room, how many times per day we're just talking about those 4 triggers. And if this happens, that's basically what we do in the chat room. Is this is happening on this time frame? Setting up for a possible plus 100 line bounce. What does a possible plus 100 line bounce look like? Let me just go back to one of those charts for a second. A possible plus 100 line bounce, and pardon me for not using laser pointers, but I just don't like them. A possible plus 100 line bounce. You have the 50 CCI over, I could do a bunny or something, over the plus 100 line. The 6 has not yet crossed back over 0. That's a possible plus 100 line bounce. So a lot of the time in the chat room, and of course, again, I'm referring to intraday trading, what we're doing is we're saying, this chart, our longer term chart, has a possible plus 100 line bounce, and that means that the uptrend had a pause and is now going to resume. But on our shorter time frame chart, we have a possible 50-14, which would mean that the shorter term trend is rejoining the longer term trend. What's a possible 50-14? The 14 is at the opposite 100 line, but has not yet crossed and rejoined the 50. So we get poised in the chat room to watch for the completion of those triggers and hit the button. And yeah, there are other nuances, but that's the core of what we're doing with the triggers. Now, what the Fibonacci work does is it tells us when we actually can take those triggers, when we can actually have an expectation of follow-through, or when we're actually looking at triggers that are going to slam into a brick wall. So that's why the Fibonacci work really is the core, but I wanted to cover the basics of the triggers first because, of course, as I said, there's that concept of falling asleep by the time we get to the CCI, but also going over the Fibonacci stuff alone can be really dry. Can be, unless you can have the expectation of going, hey, wait, now I can see how that could trigger against that zone. Why do we use Fibonacci? Okay? Fibonacci numbers are an ever-present part of nature. These are a couple of theories as to how this stuff works. I'm sure if any of you, I know most of you have expressed a lot of interest in studying Fibonacci. A couple of people here might be new to it, but you probably have read about how everything in nature is related to Fibonacci numbers. The shape of a spiral galaxy, the number of petals in a flower, the ratio of the human body proportions are legs. In the ideal human form, a leg is 1.618 times the length of an arm, and so on. There's Fibonacci ratios in every part of nature. A lot of people will say that it works in trading because it's some sort of divine plan, some sort of cosmic understanding of nature translates to trading. Maybe that's true. I don't know. I don't have a pet theory about that. I lean more towards the second point I have here. Fibonacci ratios as a determining factor in math psychology. What do I mean there? Well, fear and greed. Fear and greed. A lot of people here again, the reason I keep saying that is because if you don't know what I'm talking about in some of these ratios, say so, please, and I'll clarify it. But a lot of people know throughout the history of using fib in trading that 0.618 retracement is a very key area. In other words, price goes up this far, comes back to 61.8% of that rally. That's a key area. Is that because everyone's watching that number? Maybe. Is it because it's some sort of divine plan? Maybe. I think it's because when it gets back that far, whether or not people are actually looking at that number, something about pulling back that much in a rally triggers people on an emotional level to go, you know what, but this is supposed to be going up. This is supposed to be going up, and it looks like it's a value opportunity, and it looks like if I don't buy it now, I'm going to miss out on the next wave, and that's what's happening there. And as far as Fibonacci ratios and Fibonacci retracements being self-fulfilling, there's a kind of problem with that concept. A lot of people who don't want to give any credence to fib work as part of nature or as math psychology will say, well, it's self-fulfilling because everyone's looking at that 618. Oh, really? Everyone's looking at the same swing? I don't think so. In other words, everyone's looking at a 5-minute chart, or a 15-minute chart, or a 30-minute. No, and certainly not the way we run the fibs, because we're looking at a lot of different swings, and we're looking at where a lot of these different levels come together and point to as a confluence, or as Carolyn would call it, as a cluster of Fibonacci ratios from different swings, and not many people really do that. So, here's a little breakdown of fib numbers. This is really more of a point of interest than anything else. What is the Fibonacci number series? You know why it was originally thought up? It was about the geometrical progression of rabbit breeding. This was what, the 15th century, 15th century, 1400 and something. It's Fibonacci number series is very simply, you take the two numbers, add them together. Next number is the Fibonacci number in the sequence. In other words, 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5. That's all the Fibonacci sequence is. Each new number in the series is the sum of the preceding two numbers. What's interesting is as these numbers progress, as the sequence continues, it turns out that each number in the sequence is 1.618 times the preceding number. That's considered the ideal, the golden ratio. 1.618 is the Fibonacci number. The number 1 is 1.618 times 0.618. All of our other ratios are determined by factoring, dividing, multiplying 1.618. All of our other ratios. 0.382 is 618 times 618, 618 squared, essentially. The square root of 618 is 0.786. All these numbers are related to each other in some way. Very, very simply and basically. I don't know what the Fibonacci number is for a dry throat, but now, what is the most important number? Where should we start? I'll tell you, unless someone wants to hazard a guess. The most important number actually is the number 1. 1.618 times 0.618 is the number 1. And that is where we get our setting for the expansion tool. This is what some people call symmetry. Other people call it a type of measured move. Symmetry is simply what defines for us the strength of a trend, whether a trend is continuing, breaking. What you're seeing here is very simply, let me just give one of these guys a try again. Yeah, it's working this time. See these levels here, these numbers? That's just taking each prior decline in the context of an uptrend, okay? You understand the context of an uptrend? This is an uptrend, right?
Right.
Okay. I know you know this, Peter. Every time you had a pullback within the uptrend, we're measuring 100%, factor of 100% of each pullback and projecting from the new high. Because what we're looking for here is the pattern going to continue. Is the pattern going to continue? Is the uptrend going to continue? If so, you don't want to see it pull back any more than it's pulled back before. This chart, we have a bunch of lines here. So it goes back to the old, well, you got a bunch of lines. One of them's going to hold, one of them's going to break. Which one do I buy against? Which one matters? That's why we use our CCI, our momentum indicator, because the one that matters is the one where we see a trigger setting up, where we see our momentum indicator telling us that it's going to respect the strength of the trend. Now, if instead we had broken through all that and started to get a long side setup, we could kind of look at it, in other words, a long side trigger on the CCI, we could look at it and go, there might be a problem with that long trigger because the rhythm of the uptrend is broken. Most important thing is that factor of 1. And here's one of those cases where I'm going to minimize my PowerPoint and open up a chart, and let's see if we can actually, have an example of how to do this, okay? Let's try this one, for example. This is a daily bond chart. Okay, this is electronic bonds, the ZB contract for September. And what I'm saying is, and anyone who wants to follow along with this, I'm taking my expansion tool. And what do we have here? We have a little uptrend, right? Okay, little pattern of higher highs and higher lows. So, let's take, by take I mean I'm measuring here a pullback within the context of that uptrend. So I'm taking high to low and I'm projecting from the new high. Okay? High to low, projecting from the new high, high to low, projecting from the new high. Okay? Notice this one, by hovering over it, it's going to open up a little tooltip box. 106.31, a precise overlap, meaning that twice it pulled back exactly that much. That kind of validates the idea that these trends can have rhythm that way. We want to pay attention when it pulls back to 106.31 again. So, nice little thing you can do in FibTrader, right-click on that line and hit emphasis to remind yourself, this one's important. It happened twice. I would consider that to be a relatively key level, meaning pulls back to that point, we want to see if we're setting up for a buy trigger, breaks that point, and the concept of the uptrend is in jeopardy. Everyone clear on that? Any questions?
What happens when you emphasize it?
Got thick.
Got thick, line gets thick.
Yeah. Okay, but the idea of what we're doing here, or is this all too basic for people here?
No, this is good.
Okay. So, what am I forgetting? Well, how about we look at the earlier pattern? And this data, by the way, if you're not familiar with futures, this data gets really spotty because that was before the rollover to this contract month. This is September. And back when we were trading the June contract, there were just some people who were doing spreads and stuff, or longer-term investors who were buying September contracts. So the data's still valid, though. It just, you don't have a lot of trading happening in those days, in those earlier days. So what we need to do here, though, isn't this a downtrend? Isn't this a downtrend?
Yes.
Right? Okay. So let's take the low to the high and project from the lowest low after. That's our resistance. See how the line is longer? Quick visual reminder that the resistance has been in place for longer than the support. How about this one, the swing into the high? Low to high. Because this is the last swing where price then really failed and began to establish the downtrend. 1 second. Project from the new low. And look at that. Almost a precise overlap. Probably within a tick. Yep. Within 2 ticks. So that's your resistance to factor in there. Yes, Leonard?
I was just wondering, when you're drawing those lines from your high to your low, are you making are you also take consideration your 50 line, your CCI, where your CCI is on top and at the bottom, or are they always like that? I mean, sometimes, stochastics go up and down.
Okay, when you're doing the fib work, you can take the CCI and throw it out the window. We're determining support and resistance on the chart, and it has nothing to do with it.
Right, but you're drawing your line, from your low to your high.
Right.
Is that relationship also with your bottom chart over there,
with the CCI chart here?
Yeah, with the heavy red line.
Right.
Because that goes to the high and goes to the low. Does it ever change, or that's always? It can't be. It's always like that because it always follows the CCI anyway.
Right. The CCI, we don't have to adjust anything on the CCI, depending on...
No, I know that.
Okay.
I'm just wondering, when you draw those lines, if you got to make sure the top is...
Oh, no.
The CCI is, it should you come on down, the bottom where the CCI should be the bottom of the...
No,
picture.
absolutely not. Actually, the bottoms, the tops and bottoms very often do not line up.
Okay, so it doesn't make any difference.
It doesn't make any difference,
Okay.
because because when the tops and bottoms don't line up is when you have divergence.
Okay,
Divergence
that's what I was-
indicators. Yeah. But when I said throw the CCI out the window, what I meant was when we are doing the fib work, you don't even see the CCI. You do the fib work because the fib work is going to allow us to then look at the CCI and tell us, the CCI should tell us what is going to happen
Right.
at the fib levels.
Right.
But we're not going to look at the fib levels and say, well, I'm not going to draw this line because the CCI is doing something else.
No.
Okay.
Right.
Okay. So any other questions about the symmetry stuff?
Mark, I know you like to, I'm going back to the uptrend part of the chart, you like to take the swing into the low
Yeah.
as your first. I always have trouble.
There is none here.
Huh?
There is none.
Okay, so then you just wouldn't worry about it.
Yeah, what Jeff is mentioning, and that's another nuance in the fib work, which is kind of interesting. I always like to take, let's just assume for a second that there was an outstanding high right here. In other words, there was let's say this bar was a little higher. The level, the expansion where the trend is possibly changing is one of the most important swings that you can use. So if I actually had a swing high here and I could go high to low projected from new high, I would probably emphasize that one too and make it bold. And I'd say that's kind of key to determining whether or not the trend is going to hold in the uptrend. The fact that there isn't a swing that I can use here, and actually won't be until we take out this swing high, tells me that the uptrend is really not that strong. Okay? In other words, here's a factor. Not exactly a nuance, it's more like a rule. You can't, in looking for the support, and I think I have a page on this actually in the workbook. In looking for the support, you must, in an uptrend, you must use swings that have lower highs. In other words, you need to have an uptrend where you're taking out the swing highs. That's why I could go high to low projected from high, high to low projected from high, high to low, but I can't go high to low projected from high because this high would have to be higher than this high to confirm that it's an uptrend and that this is a swing that's part of that uptrend. Okay? Everyone see what I'm saying? Mm-hmm. You can't, if you were to take high to low and project from here, you're going to get a support level down here. How does that have anything to do with an uptrend? You need to take out successive highs before you can factor them in that way, just like you need to take out exceed lows in order to pull back, in order to use those corrective bounces. That's why I could go low to high, both from this low. There's another one in here too that was violated. If you take a look right here, I think this was violated. Low to high, projected from low. See how that was broken? Back here, and then we had a pullback, or not even gonna try. We had a pullback, and then it went up again. Whenever you see a symmetry level broken that way, it means that you can expect more in that direction. The strength of that resistance, strength of the downtrend, the break of that resistance indicated that the downtrend, there's a question mark on it now. Is the downtrend really over or not? As soon as you start breaking the symmetry in one direction or another, it tells you should have more movement in that direction. Might be a pullback first. But as long as you have more, it means that, you could have a reversal at that point. So the fact that that minor one broke doesn't really mean much to me. The swing into the high, though, is important, and so we can emphasize this too. Okay, so now what you have here is a situation where until one side or the other breaks, it's potentially range bound. The side that breaks is going to tell you which trend is winning. As soon as you have symmetry on both sides, it means your resistance is defining the rhythm of the downtrend. Well, resistance is kind of stronger. It's been in effect longer. It's from larger swings. Resistance has been in effect longer. That strong resistance right there. You have support building. So there is a way of defining the trend in both directions. And what you need to see is to have one side or the other break to tell us which side is going to win.
Can I call it a triangle pattern?
I'd want to add some other levels. I don't really see a triangle there because you're making a pattern of higher highs.
Okay.
You know, it didn't bounce.
Understand.
Yeah, congestion. Any questions on symmetry? I mean, any questions at the moment? I'm sure there'll be a lot that... Okay. Here's this is the expansion line stuff that we went over yesterday. Okay, just so you can have the setting there right in front of you. Yeah, here's the rules for symmetry. Now this sounds really confusing, and I should find a way of making it into a dirty limerick or something so it's easier to remember. But it's really simple stuff. For support, take the high to the low of corrective declines. What's a corrective decline? It means that we have an uptrend and you got to pull back within the context of the uptrend. That's a corrective decline. Take the high to the low of corrective declines and project from the highest high after that corrective decline. That's exactly what we just did to get this support. Take the high to the low and project from the highest high after. Okay, what that means is you would not go high to low from this high. That's meaningless. You must project from the highest high after because you're measuring from the extreme of the trend to see if it's going to pull back that much again. Okay? The second line here is just the same thing reversed. For resistance, take the low of the high of corrective rallies and project from the lowest low after. That's what we did to get the resistance on this chart. Okay? We took our corrective rallies in the context of the downtrend. How did we know it was a corrective rally? Well, we didn't when we were back there, but as soon as we violated the swing low, the downtrend is continuing, and that was only a corrective rally. It verified the pattern of lower lows and lower highs. So you take those, project from the new low. What you don't do is, here's a no-no, low to high from here. See? What in the world does that mean? That's not the extreme of the trend. This is the extreme of the trend. You project from the lowest low afterwards. Next rule. A higher high must be present to find support. That's what we were talking about not being able to use a swing high up here to project from a high here. Should do that the other way around. Higher high must be present to find support. Really, you guys can read through these on your own. It's kind of, if you have any questions about them, about these rules, let me know. This is just the, the basics distilled down into 3 rules. Looks like 6 because I'm talking about uptrend and downtrend both. But these are the rules of symmetry, and if you guys are playing with it, those of you with laptops here, if you're setting these up and you want me to see if you're doing it correctly at all, let me know and I'll come around and have a look. Now it gets really interesting. We add the retracements. We add the actual Fibonacci magic. The reason I call it Fibonacci magic is because this is where we pull in those psychological factors. We're looking at the 618, we're looking at the 786, we're looking at our extensions. These are all the mass psychology, as I like to think of it, decision points in the market. What do you think would be the strongest of the fib levels?
618. 618.
Okay. Anyone else?
100, 618.
Who said that? 100 and 618.
I did.
You get a cookie. You get a cookie because the strongest ones are the ones that are going to overlap our measurement of the trend or symmetry. Those are the strongest ones. In other words, if you have Fibonacci retracements or extensions overlapping the 100% projections that define the trend, that's some strong stuff. So let's see what we actually have on that bound chart. Let's go back to that bound chart. Okay, what if we were to take our retracement tool? Really pretty simple stuff here. Most of us have run retracements before. We're looking now, focusing on that little uptrend that we were looking at before. So we want to see what kind of Fibonacci support we have there. So we can take low to high with our retracement tool. And this guy, the 236, is pretty weak. It's not really a strong level. I would only leave it there on the chart if you were overlapping a symmetry level. Standing there on its own, I'm going to take it out. Control left click. Okay? But look at our other levels. A 382. Now, if a trend is strong, it will often bounce at a 382, especially on a longer term chart like a daily. It will bounce at a 382 in general. But the thing is, that 382 is right by our emphasized symmetry support. It's 2 ticks away on a daily chart yet. So that I'm going to leave there because that's telling us that this is a major support area. Our other symmetry is right near 0.5. Again, if a trend is strong, it will often bounce to 0.5. 618, and you can take notes too, and I'm being very bossy because running a chat room has taught me to be bossy. I used to be much more laid back, but when I have to get a point across, I'm going to take notes.
There you go.
618 is generally the turning point when a trend is going to continue. When a trend is established, and and there's a lot of interest in that market. There's a lot of volume. You will very often the most likely place for the trend to resume would be a 618 retracement. 786 is the last holdout. 786 is where the fear and greed factor gets to a point where it has to decide. There hasn't been enough interest in the market. It's also where you see markets bounce when there's low volume. When there hasn't been enough interest to make the market hold and catch and reverse at a 618, 786, if the trend has any chance of continuing, you'll see it bounce at the 786. Generally, when you have a break of the 786, price will extend instead to the 1272 extension. Does everyone know how see where, why the 1272 is below the low we used? 1272 is an extension, 1.272, so it's actually this low to high times 1.272 downward. Okay? That would be the target if we were looking for shorts at this point. Because just like 618 is where that fear and greed factor kicks in, the greed factor. Let's say people want to drive this market up and it pulls back to 618. That's where the greed factor kicks in. Oh, wait a minute. It's supposed to be an uptrend. It's supposed to be an uptrend, so let's all buy. 1272 and 1618 are where the fear factors kick in too. That's where they say, you know what? The market has moved, but maybe that's enough for now. Maybe it needs to... Yes, Chris?
Sorry, just stepping back to your comment about the 786. Do you find that there's some time, like an acceleration in price between the 618 and the 79%? There's a bit of a giveaway there?
Yeah.
Change the liquidity a little bit?
Yeah, there can be, and of course, once the 786 breaks, it really takes off.
Yeah. I'm totally in the same mindset and agreement with your comments concerning the psychological mathematical pain points and moving within a
Right.
Fibonacci rhythm. The pain to fear degree is very much what we see.
Cool. Yeah, I was looking at how you were using instead of using extensions, you were using those minus factors and stuff. I'm in agreement with that too. It's just another way of using the tool. And yeah, to me, it's all about the math psychology with that. And a very interesting thing that we see day after day. As I said, the 786 is kind of the holdout level. If that level breaks, the market is most likely extending in the other direction. So Jackson mentioned triangles before. We can very often project that we're in congestion when you see a 786 hold, and then the next 786 in the other direction also holds, because that means that everyone's like, I don't know. And you will so often, when congestion is setting in, you will see a precise bounce at the 7. In other words, it would bounce at the 786 support there, and then we'd have a new high to low. So we'd go high to low with the retracement tool. We'd have a 786 around here, come back up and bounce off that 786. You know what that means? That means don't touch that market at the moment, because it's just going to keep doing that until there's something to give the market directionality. And you can, if you try to fight that, you're going to lose money. The only people who make money in that case are people who are, whether they're trading on a daily basis, that would be really tough. But intraday basis, if they want to just scalp back and forth, scalp the rails of the triangle. But it's interesting because you can, if you just see that bounce once off a 786, project the opposing 786, see it bounce again, even if it doesn't look like a congestion pattern yet, you have fair early warning that you have some congestion and might as well step away from that market. And what's interesting is that the 786s very often correspond with the CCI plus and minus 100 lines. So when you start to see the 50 CCI bouncing between the 100 lines and not penetrating outside of them at all, you're getting a warning, this market's congested. Step away. So that's just a little rundown on what the patterns, what the levels mean. We have our support there. One of the things you can do with Fibonacci clustering is we also have another low here. So you can actually run the retracements again, low to high. Okay? And what that's going to do, again, we got some really minor stuff here standing alone. It adds to some of our support areas. We now have, here, look at the significance of this zone. I'm going to use this regular pointer. Look at the significance here. We have 0.786 of this low to high. What did I say about 0.786 before? If it breaks, it's probably going to extend down to the target. So that means if the market doesn't want to go here, take out the prior swing low and doesn't want to go down here, it's going to hold up here at the 786. We also have 50% of the major low to high. 50% alone, it's worth something. What's most important, what's telling you most importantly is that if the market really has strength, it's people really want it to go up, and they're not even waiting for the 618, 50% is where it will change. Point is that overlaps the 786, and it's very close to our symmetry support, measurement of the rhythm of the trend. That is a cluster, or a confluence of Fibonacci factors, measured in different ways. We used 2 different swing lows to get the retracements, and we used high to low projected from high to measure the strength and rhythm of the market. So we have 3 reasons why that's a support zone. That's okay. Happens to all of us. Everyone get that? Okay. Let's take a look the other way around here. What if we take our retracement tool and go from our major high down to our low? Okay, these have been violated already, our minor levels. 382 is not so minor from such a big swing. Definitely been broken. That means that there isn't an overwhelming amount of interest in driving this down. We also have another outstanding high. The highs and lows you want to pick are the ones that really just jump out at you. The ones that are like, yeah, the market pivoted there. Market made a change. Market made a shift. High to low. Okay, what are we getting now? Pretty similar levels. One more here, high to low. and we are adding to the strength of the resistance. This is telling us at this point that this area, 108.31 up to 109.16, is some pretty formidable resistance that has to be broken through. And that's how you do it. That's the quickie version, showing you that how when these Fibonacci retracements overlap the symmetry work, you get this clustering, and the reason it's important is because you're measuring the market in different ways. You're measuring the strength and rhythm of the trend, and you're measuring these psychological turning points. When they all line up that way, you have all the more reason in the world to believe that there's a reason for the market to shift there. 1272 and 1618 are targets. If we break through the retracements, including the 786, that's where you can expect either a pause or a pullback. What you want to do, I'm sorry Leonard's missing this, but what you want to do in order to project these targets is look for U-turns. What do I mean by U-turns? This. Nice little U-turn there. You can project these in advance, assuming a U-turn. But in this case, I would go low to high, high to low, sorry. And you see, these would be the targets of the most recent swing. That's another reason to believe that we may get a pullback. Notice that the second target, 1618, is right inside, right overlapping other resistance. So we've now measured the market, we've now measured these swings in three different ways. Retracements, extensions, symmetry. Retracements, extensions, expansions. Three different ways of measuring. They're all pointing to the same area. Kind of tells us something. Kind of tells us that's formidable resistance at this point. Any questions on that? Okay, back to the PowerPoint. Retracement rules, just like the expansion rules, the symmetry rules. These are for your reference more than anything else. We don't have to go through each one of these. Basically, it's what I just did. You're going to start with the lowest low on the chart, drag the retracement tool to the highest high, repeat with each outstanding low. Reverse it for downtrend. That's what we did. The optimum number of retracement series to run is 2 to 4, because you want to see if you're going to get that clustering, where you have 50% from one swing and 786 from another swing. If different swings point to the same price as significant, it's significant. That's what I'm saying here. Strongest support, I'm telling you I'm not going to read it, then I read it anyway. Strongest support and resistance zones are where retracements from different lows or highs cluster together with symmetry. So these are really all the instructions you need for retracements. The main thing is in the interpretation, and that's why I want to get some of this stuff out of the way so we can look at how to interpret these charts. Targets are 1272 and 1618 of the swing into the setup. What do I mean by that? Well, like I said, you look for U-turns. Let's find a couple more examples of that. Here, let's just say we were back here, back in time here. You see this low and this high? One of the questions you're going to ask, you're going to ask the chart, you're going to ask your tools, is what if this completes as a U-turn? Like so. Where would that land? Or this one? Before you even knew that you were putting in a significant high here. You want to see what happens if this low continues, where it may terminate, where there should be a target. So you want to assume this is going to be a U-turn. All you have to do is take your retracement tool and go low to high. And you will find the support levels in the way of this continued decline, and you will have possible targets if the market is going to continue the decline. If the market breaks the 786, the likelihood is that you will make it towards or to the targets. And eventually you did. It doesn't mean that it's going to happen all at once. Sometimes you see this kind of situation where the 786 breaks and then then it bounces a little bit. But that's what you don't have to wait for a price to be almost at the target, is what I'm saying, to project the target. And I'm doing something here I shouldn't have.
Mark, when you say it breaks, it's going to pass it by 2 ticks, correct?
It depends on the time frame. And, I mean, like bonds, we do 2 ticks intraday, but on a daily chart, we want to see a close on the other side.
Okay.
And Jackson was just asking about what constitutes a break, and we've actually spent a lot of time formulating rules for that, for intraday versus daily charts. Intraday charts, for example, if you're trading the intraday ES, the mini S&P, 2 ticks is a break. You're trading the Russell, 3 ticks, the mini Dow, 3 ticks, bonds, 2 ticks. Daily charts, you have to be kind of more lenient about that. You either want to see a close on the other side of a level, or you want to see a real, penetration that has, it's like it shoots through a whole cluster. Okay, the market may give you a lot more than the 1272 and 1618, but has a high likelihood of pausing, at least at that point. You can use that for your risk-reward decisions. In other words, if you are seeing a 1272 or a 1618 right in front of you, right in front of where you're getting whatever trigger you're using, or one of my CCI triggers, if you're seeing that you're triggered in right when you're at that target, let's say, let's use a stop for a second. You have a $10 stop. And because of the way the swings are lining up, your first target is at $11, but your support is at $8. Well, the right way to do that would be to put your stop below the $8 mark. So you need to risk like probably $2.50 for a target of $1. You can kind of say, well, that's great. I think I'll see you tomorrow. Risk-reward factors using the targets. How often do we see price actually bounce really definitively at those targets? A lot of the time. Trade management. This is just, again, I'm kind of giving you a lot of stuff at once because I want to get the basics out of the way here so we can go over examples and hopefully generate questions. Trade management. Enter on multiple time frame triggers with a symmetry Fibonacci zone. In other words, if you get your CCI triggers, or those of you who don't want to have anything to do with CCI using other triggers, still try to keep in mind that multiple time frame concept. For me, it means that I'd want to see the CCI telling me something on more than one time frame. I'd want to be like right against, let's use this example again. Here is our daily bonds. Let's say this pulled back to our support here, which is 618. It's a 618, and it's also a couple of levels of symmetry. There's all sorts of support right here. This is the stuff we emphasize because it repeated also. If this were to pull back to this support cluster, this support zone, what do you think we would see as far as a trigger if it were going to reverse long off that cluster? Anyone want to hazard a guess of what kind of trigger we could get there, a long side trigger with the CCI?
50-14?
Well, the 50 is already above zero. You could also get a 50-34Z. Yeah, you get a 50-34Z where as price comes down here, our 6 at least is 6 period is going to cross down below zero. 50 will come down probably. This is why we say we'd have a possible, as we saw it second, we'd say we have a possible 50-34Z. You'd see the 50 coming down towards the zero line, the 6 crossing below zero. If the support's going to hold, you'd see the 6 reverse, go back above zero, and you'd have a long trigger. You'd have a 50-34Z. But I want to see it on multiple time frames, so I want to take a look at the weekly. Let's take a look at the weekly. This is down here, yep. Okay, let's just open a separate weekly chart, it'll be easier. Okay, there's a problem with the long at the moment. There is a problem with the long, and you can pretty clearly see what it is if you get familiar with the CCI triggers. Let me just get the right, make this a little more legible. Our problem with the long from the weekly perspective, and again, this wouldn't keep you out of a bond trade if you were trading intraday, which we've done well with. But if you were going to, do a set it and forget it bond long, we use the same rationale with stocks too, by the way. Problem here is that your 50 CCI is below the minus 100 line. So while you're setting up a possible long side trigger in the daily, this is still in a great position to give you a weekly short trigger, a minus 100 line bounce. So you may very well want to skip the idea of longer term longs at the moment, because you have a lot of resistance. If we did the fib work on this chart, we don't even have support. There's no swing high for me to use to get a symmetry in the concept of this uptrend. Instead, what you would see is a clear case to the downside. See? If you hadn't even looked at that exciting daily chart telling you about the possibility of a great long, if you were just looking at the weekly and trading on that time frame, you'd say, oh great, there's going to be a really fantastic short trigger coming up. So what I would want to see to take the long on the bonds would be the possibility of that long side trigger on the daily, and also the 50 CCI being in a position on the weekly to give us a long side trigger there too, like just approaching the underside of the zero line. Because if that was going to rally a little bit more, then you'd have a 50-34 long on the weekly too. That would be a good long. Not happening here. That's how the multiple time frame stuff can keep us out of trouble. Okay, any questions on that? And we'll see plenty of examples of where the time frames are working together. In this case, you're seeing a time frame conflict. Everyone see that? I'll put the charts next to each other. It might be a little easier. Okay, again, we're talking about a longer term trade here, something on a daily, doesn't mean that you have to stay out if you're trading something intraday. But you see, just as we're beginning to trigger long here on the daily, we're still in position to trigger short here on the weekly. Yes, Juan?
Would you, on a smaller time frame, you would get, compared against a weekly, you would probably get longs. Would that weekly resistance be a profit target? Possible profit target? Let's say you pulled it down to a 15-minute or an hourly.
You mean if we were trading it intraday?
Right.
Yeah. Well, actually, we do have the targets already on the daily. We're almost at the current daily swing target. There's really no other swing that we can use to forecast a U-turn, because we don't have the next U-turn we would look for would actually involve this swing high,
Right.
because there's no other swing high in here. This decline was so dramatic. Okay. Leonard?
On your weekly chart there,
Yeah.
and you have the CCI, is that all ohm?
Yes.
That's all ohm?
Yes, and on the daily as well.
Yeah, you only look at the one. The only time you look at the two steps is on the volume.
No, we're looking at two right now. We're looking at daily and weekly. I just have it on separate charts.
Yeah.
Okay, I just have.
So in other words, you have them all right. You got your volume, you have your 1545, and then you look at the daily, and then you got the weekly. So you're looking at all these at the same time.
Well, it depends on what time frame you're trading on. If you're trading on intraday, I'm not going to look at a weekly CCI. You know what I'm saying? I mean, you don't have to look at all of them. You're just looking at the time frames. You're looking at your execution time frame. What we're talking about here on the bonds would be a daily long, a daily trade. And what I was saying before is what you're going to look at least, is your execution time frame, in this case the daily, and the next higher, the weekly. Now, if I wanted to, I could put the weekly CCI on the daily chart. But I just didn't in this case. That's personal taste, personal preference. There are plenty of people who don't like the volume intraday. They don't like the volume CCIs all on one chart. They want to have three separate charts. That's fine too. I do it that way to save space. I put the intraday stuff, I put it all on one chart. But you are actually, something we sometimes do too, if we want to keep the weekly chart handy, for instance, just do it like this. See, that looks exactly like that 500,000 volume from the intraday too. It's, I'm talking about all kinds of different time frames here because we have traders in the room who are interested in different time frames. How many people here are actively intraday trading? Okay. Who here has never put on an intraday trade in their life? There's no problem with that either. Anyone prefer daily? Daily time frame?
Depends on what we're trading.
Sorry?
Depends on what I'm trading.
Okay. All right, so a lot of us are focused more on intraday. Sorry?
Stocks are great, I think.
I like weekly.
Weekly? Yeah. Weekly's good. Well, in the case of like these bonds, if you saw a stock like that, I would say you have a real problem putting on a long-term trade with that. And that's how we've done so well with our stocks, because we've been analyzing a lot of stocks to come up with the ones where things are aligning between the time frames. And yeah, we're getting in based on what we're seeing on the daily, but it's only when the weekly stuff is letting us. And I have a couple of long-term clients too who are still fanatical, still try to pick bottoms. Still really try to pick bottoms. And I'm like, could you just let the trend establish itself a little bit first and then buy the pullback? No, they don't. So then when it turns into his mark, how much do you think this is going to bounce so I can get out with a minimal loss? Because it's just, you don't try to do that if you want to look for a long-term hold. I mean, again, for those of us trading intraday, the bonds, for example, have been very productive intraday. I wouldn't let any of this stuff keep me out of an intraday bond trade, except for like the first couple of days this coming week, because if we come right up to this resistance cluster, what you're going to see on the intraday then, and if we were trading intraday, what I do is basically take this weekly, put it aside, here's our intraday bond chart, and I'd say, okay, well, you know what, we're coming up to our daily resistance. What we'll probably see happen, because we've seen it a million times before, we'll probably see happen on the intraday, it's going to flatten out. I think Chris was talking about this yesterday too, how you see something wacky happening, all of a sudden you have a nice move and then the market's doing this. Let's take a look at the next higher time frame and see what happened there, or what's going on there, because there's probably a reason why that's flattening out for the moment. So until that decision can resolve itself on the daily, if this resistance is going to hold, it doesn't necessarily mean that it's going to go plop. It might skitter around for a bit and make intraday trading on that kind of difficult. Breaks through instead, you'll have another nice intraday set of moves. But as long as it's hanging out there, you want to wait and kind of see what the deal is. That would be the example of if you were intraday trading this, as opposed to daily and weekly, we're using the intraday and the daily. Okay? Who's bored? Everyone is really quiet. No questions, nothing? Is this interesting or?
Yeah. Okay. It's interesting, yeah, you gotta do it.
Yeah.
You gotta do it.
You gotta do it.
We figure it out, there's a lot of lines and stuff.
Well,
You gotta do it.
if you do nothing else as far as...
I understand.
Okay. If you do nothing else as far as these crazy lines,
Some of that stuff I use, yeah.
if you do nothing else from this stuff, just use the symmetry lines. Or if you're doing something else already, just add that. That's going to make a big difference.
I do the 618 and the 100 and
Okay, I'm just saying I advise that if you leave here hearing nothing else that I've said, and this, I'm not directing this at you, I'm just telling everyone, if you want one thing from all this, try the 100% expansions.
Right,
the symmetry.
right.
Okay, because the measuring the rhythm of the trend makes a big difference. It'll be better if you can add the other stuff, but if this seems daunting, start with that. Just start with the expansions. That's pretty simple to learn to apply. Then add the other stuff in gradually. That's partially why I was saying this morning, if we don't have time to get into like the timing work too much and all that stuff, I don't blame me and I don't blame you. Because if I keep throwing all these different ways of adding lines to the chart, we could take out a patent on eye glaze over methodology. It's really simple for me because I've been doing it for a while. And as a matter of fact, I think Jeff knows this too. I have this little thing, like when I take a little break for lunch or something in the chat room and I have to, I come back and I look if everything's changed. I do this thing called aerobic updating. Aerobic updating means that stuff has changed and I want to get all the charts up to date. I can do 20 of these charts in like a minute because I've been doing it for so long. I wouldn't expect anyone else to leave here being able to do that, but try to incorporate some of these techniques into what you're talking about. Right now we're mostly talking about how to get the support and resistance together. The real stuff I want to talk about with you guys is what it means. And that's why actually we're almost at the end of this PowerPoint stuff. Then we can get into playing with some charts. and discussing and clarifying what this stuff means. Okay, so we got our bond chart stuff here. What else is in this wacky PowerPoint? Trade management, yeah. Well, this trade management thing is a trading plan, at least a framework for one. Multiple time frame triggers with a symmetry Fibonacci zone. Watch for the other time frames to complete their triggers. Now, this is something that we'll see on other charts, other examples, where, or actually even the example that Don had talked about before. Let me go back and find that in the PowerPoint. The multiple time frame thing we had here. Don had asked before, what if you had here minus 100 line bounce trigger, and here you had a 5034Z trigger? You don't have a trigger on the highest time frame. What you have is approaching the possibility of the trigger. We have plenty of trades like this where you have the highest time frame with the possibility of setting up a trigger, but the shorter time frames are triggering. You can take those trades. You would not take these triggers if the higher time frame 50 CCI were still above the 100 line, because that might be setting up a 100 line bounce trigger. But as long as this is crossed below the plus 100 line, you could be getting, and this is what happened in this case, a 5034 short. So you can take the shorter time frame triggers in the expectation of the higher time frame trigger. So the higher time frame becomes a danger zone. You want to watch the chart as you're approaching that zero line to verify that you have the possibility, that you have the follow-through, the 5034 in the higher time frame. Be aware of the danger zones. 786s, like I said, if you don't break the 786, you're either entering into congestion, the trend is taking a last-ditch effort to resume instead, and in the other direction. You want to see that 786 break so you can get to targets. Be aware of those things: the 786, the CCI zero lines, symmetry that's in the way. Let's say you were long right now on those bonds because you did have a long trigger on the daily. Well, you want to be aware that we have that resistance up ahead because that's your danger zone. That's a place where if it wants to go down instead, if the market is going to be motivated to reverse, this stuff is your danger zone. You'd have to be ready to jump out if you had indications of reversal. Warning signs that your stop may be hit. Let me go back to the other one. Place your initial stop on the other side of the closest symmetry. Your money management may require a closer stop. Mine generally does on the intraday stuff. Ideally, you would place your stop on the other side of sim. Like if you were, again, let's just use that daily bond chart because we have it set up. If you were long on the bonds on a daily time frame, you put your stop down here because the idea is you want to put your stop in a place where if price reaches it, it violates the reason for being in the trade in the first place. In other words, it violates the uptrend has been violated. That's where you should be getting out of the long. On the intraday trades, I can do that on a daily, on a longer term, like on our stocks. I have no problem with that. But on intraday trading, that can sometimes be a little bit far away. You can sometimes get the best triggers and you have the support kind of a little bit too far away. My money management doesn't allow me to risk $150 per Russell contract. I'm just not in a place where I want to do that right now. So you might have to figure out, your own money management, risking 2% per trade, for instance. A lot of us are familiar with futures at this point, right? We know what we're talking about with the Russell. You might have to say, okay, well, I can only afford to risk $100, 10 ticks on my Russell. So frequently, your initial stop is going to have to be arbitrary in relation to the symmetry. That's the risk we take in trading. In other words, the market may still decline and touch that support. And still take you out of the trade. That's why we want to see the multiple time frame triggers to tell us we have a good probability of it lasting through that way. And basically I'm just going through the points of this trade management thing. Warning signs that your stop might be hit. Those danger zones holding. You want to look at the CCI, make sure it's following through. In other words, that if you had a cross of the zero line